At 5:44 in the morning, London time, March 8, 2022, nickel was trading at $70,000 a ton. 24 minutes later, $101,365. A metal that goes into kitchen sinks and EV batteries had just gained $30,000 a ton. In the time it takes to drink a coffee, the CEO of the exchange was asleep. The automated safety system that should have stopped it, the price bands, had been switched off hours earlier by his own staff. Court testimony would later show they thought the price was an error, so they disabled the thing designed to catch errors. And when the CEO woke up, he made a decision almost no exchange in modern history has dared to make. He didn't halt the market. He didn't freeze positions. He erased the day. Roughly 9,000 trades, around $4 billion, deleted, as if the morning had never happened. Traders who were up hundreds of millions went back to zero. Legally, officially, retroactively. This is not a story about a price spike. Price spikes happen. This is a story about what an exchange does when the math says one of the biggest industrial fortunes in China dies at market open, and the exchange decides the market is the thing that has to give. I've read the independent Autopsy, the Oliver Wyman report commissioned by the exchange itself. It's 44 pages of careful, anonymized language. Tonight we put names back on the tags. Start with the body. The London Metal Exchange, founded 1877. The place where the world's industrial metals get priced. Aluminium, copper, zinc, nickel. Over 3.5 billion tons changing hands a year. Fewer than 1% of its contracts ever end in physical metal. The rest are promises. Now the client. Xiang Guangda. Chinese media calls him Big Shot. His company, Tsingshan Holding, is the largest nickel producer on Earth. But, and this is the detail the whole case turns on, Tsingshan mostly doesn't produce the nickel the LME trades. The LME contract is Class 1. Refined metal, 99.8% pure. Tsingshan produces nickel pig iron, NPI, a cheap Class 2 product running 3 to 14% purity, invented in China to feed stainless steel mills. Xiang believed his own expansion would flood the market. Prices too high, supply coming. So he sold forward, massively. By early 2022, the review found 4 users sitting on short positions between 13,000 and 24,000 lots each. A lot is 6 tons. So the biggest of those was roughly 144,000 tons of nickel. Sold. In advance. Here's the flaw, and it's structural. He was short Class 1 metal he doesn't make. As a proxy hedge for Class 2 metal, he does. As long as the two prices track each other, fine. Textbook. The moment they diverge, it stops being a hedge. It becomes a naked directional bet, wearing a hedge's paperwork. And there was a second flaw. The position wasn't in one place. It was smeared across as many as a dozen banks and brokers, split between the exchange and private over-the-counter deals. On average, the 10 largest shorts were spread across 5 members each. No single institution could see the whole animal, including the exchange. Remember that. It's the murder weapon. You'd assume there are rules against positions this size. There are, sort of. The regulatory position limit for nickel's benchmark contract stood at 80,200 lots, over 480,000 tons. The largest short in the market was a third of that. The limit wasn't a fence, it was a horizon. The LME had its own tripwire, an accountability level at 6,000 lots, where the exchange can ask you to explain yourself. The review found the LME routinely followed up on single-date breaches. Small stuff. Large net positions exceeding the threshold, not routinely investigated. The tripwire was live. Nobody was watching the monitor. On February 14, 2022, Bloomberg publishes the rumor. A trader known as Big Shot has amassed a giant nickel short, and a mystery stockpiler holds 50 to 80% of the LME's available inventory. The words "short squeeze" are already in print. Warehouse stocks had bled from 173,000 tons down to 80,000. 10 days of world demand. 89% of the warrants, the documents that let you actually claim the metal, sat with just 3 entities. A market this tight is dry tinder. 10 days later, February 24th, Russia invades Ukraine. Russia supplies over 20% of the world's Class 1 nickel, the exact grade the LME contract settles in. The exact grade Xiang was short. Every metal rallied on the invasion. Only one had a 100,000-ton short position standing in front of it. March 4th, Friday. Nickel splits from the pack. By mid-morning, it's up nearly 7%, while no other major metal has moved more than 1. The review's trade data shows over half the buying that day came from just 5 physical producers and traders, small players covering shorts, quietly heading for the exits. The exits were narrower than they looked. Resting sell orders on the electronic book had collapsed to 30% of normal levels, at times under 10, because liquidity providers had read the same Bloomberg article as everyone else and had no interest in standing on the tracks. The bid-ask spread touched $250 a ton. Normal is 15. Margin calls that Friday? $3.5 billion. 3.5 times the recent daily average. The market closed for the weekend with the big shorts still in place and their cash reserves already bleeding. Monday, March 7th. The market opens at 1 a.m. London time. Within an hour, nickel is up nearly 11%, more than all of Friday. And here's the forensic detail that matters. Almost nobody big was buying yet. Net short covering in that first hour was about 1,300 lots. Trivial. The price wasn't rising because of demand. It was rising because there was nothing on the other side. Fewer than 30 lots of sell orders within 1% of the best bid. A market 100,000 tons deep, and the ask side of the book was functionally empty. At 7:30 a.m., LME Clear runs its standard margin cycle and calls members for $5.1 billion. One morning run. 4 members missed the 9 o'clock deadline. In the prior 6 months, the number of late calls was 0. Now the machine feeds itself. Rising prices trigger margin calls. Margin calls force shorts to buy. Buying into an empty book spikes the price, which triggers larger margin calls. By 1:30 in the afternoon, the clearinghouse has called $7.5 billion intraday. And then it does something remarkable. It stops calling. Suspends intraday margin entirely, rolls the exposure overnight, because the calls themselves are accelerating the fire. The day closes at $50,300, up 69%. Measured against 20 years of data, that is a 25 standard deviation move. The regulatory stress test the clearinghouse had run with European authorities in 2019 imagined 23%, spread over 5 days. Monday did 3 times that, before dinner. Since Friday's open, nearly $16 billion in margin calls. Met. The review notes dryly that at least one member posted margin beyond its known pre-event liquidity. Read that sentence again. A clearing member paid with money the system didn't know it had. Overnight, just after midnight, Bloomberg reports that China Construction Bank's LME unit has been given extra time to pay hundreds of millions in missed margin. A clearing member, publicly reported as unable to pay on schedule. To every trader still awake, that headline meant one thing: the plumbing is cracking. March 8th, 1 a.m. The market reopens at 50,000. Somewhere in those small hours, inside the exchange, staff are watching the price bands. The automated volatility controls get hit over and over. The official report states the controls did not control price volatility. Court testimony from the 649 pages of litigation that followed is blunter. Staff disabled them. The prices looked so wrong, so impossible, that the humans overrode the machine built to stop impossible prices. The last guardrail on the fastest-moving metal market in history was removed by hand. At night, while the chief executive slept. 4:49 a.m., 60,000. 5:44, 70,000. Then the vertical. In 24 minutes, the price of the world's benchmark nickel contract rises another $30,000 to $101,365 a ton, on volumes that were not unusual. The review found the average price impact of a single trade exceeded $225 a ton, with the bid-ask spread stretching to $5,500, $5,500, between the buyer and the seller, on 1 ton of metal. This was not trading. This was a book with one side. Around 5:30, Matthew Chamberlain, CEO of the LME, is woken by a phone call. He opens his laptop to find the market his institution has run since 1877, printing numbers with no relationship to any physical reality. At 6 figures, the 2 biggest buyers simply stop. 7 minutes later, the price is back at 80,000. Nothing supported it either way. The clearing system, still running its math in the background, calculates the variation margin owed on the morning's move, $19.75 billion. Calls that, and multiple members default. The clearinghouse eats their losses. The default fund follows. Exchanges have died from less. Kuala Lumpur, 1984. Paris, 1974. The review lists them. It's a graveyard tour. At 8:15 a.m., the LME suspends nickel trading. Then, at 12:05, the announcement. Every nickel trade executed on March 8th, canceled. All of them. From midnight onward. The hedge funds who bought at 50 and watched it print 100 were not paid and told, "Well done." They were informed that their trades had ceased to exist. Elliott Management calculated its erased profit at $456 million. It sued. Jane Street sued. They lost. The courts held the exchange had the power to do it. The rulebook allowed the exchange to delete history. It just had never mattered before. So, cause of death. The independent review never names Tingshan. The report anonymizes everyone. But its autopsy findings line up like exit wounds. The exchange couldn't see the position because it was fragmented across a dozen counterparties and buried in OTC contracts outside its jurisdiction. Management looked at the on-exchange piece and mistook a limb for the whole body. The report says exactly this. The exchange-cleared component created an impression that it constituted the entirety of the position. The position limits were too high to bind. The accountability framework generated alerts nobody escalated. The volatility controls existed, and then didn't. Each layer of defense was present, staffed, documented, and inert. And the cancellation itself? Strip the outrage and the logic is cold. Settle March 8th at the printed prices, and $19.75 billion in margin comes due immediately. Several members can't pay. The clearinghouse absorbs defaults it may not survive. Cancel the day, reprice the world back to $48,078, Monday's close, and the system lives. The exchange wasn't protecting Xiang Guangda. It was protecting itself. His survival was collateral. Xiang, for his part, never blinked. While the market was suspended, he negotiated standstill agreements with his banks, refused to close at the highs, and unwound the short weeks later around 30,000. Tsingshan operates today. The billionaire the market cornered is the one participant who walked away structurally intact. The people who took the loss were the ones whose trades had been correct. The market reopened on March 16th, with new daily price limits bolted on. It promptly went limit down. Day after day, the price fell the maximum allowed and stopped, because the March 8th prints had been a hallucination, and everyone knew it. It took weeks to find a real price again. The review's recommendations run 7 objectives deep. Watch the OTC market. Tighten position limits. Rehearse defaults. Rebuild trust. The LME has adopted most of them. The Bank of England and the FCA ran their own inquiries. Chamberlain, who had announced his resignation weeks after the event, reversed it and stayed. Volumes came back slowly. Some funds never did. Here's the observation I'll leave you with. Fewer than 1% of LME contracts ever turn into metal. The other 99% are promises, and the entire $20 trillion architecture of derivatives rests on the assumption that a filled order is a fact. On March 8, 2022, 145 years of precedent met one overexposed client, and the facts lost. The exchange still opens at 1 a.m. London time. The CEO, presumably, still sleeps through it. Subscribe to the White Collar Autopsy. We'll see you in the next dissection.